In this video, we're going to talk about the forms of business organization. The three major forms in the United States are sole proprietorship, partnership, which could be general or limited, and then a corporation, which could be an S corporation. Now, on this slide, they have limited liability company under corporation, but I would like to make an adjustment to that. Limited liability companies are typically listed under partnership, in between partnership and corporation. They're not exactly a corporation. They're more like a company that belongs under these two. However, I didn't want to alter the slides or the textbook, but do understand that if you hear people talk about limited liability companies or LLCs, you might have heard LLC before, that's more of a company that will go in between the partnership and corporation line. So that's just a quick clarification, so there's no confusion as you go out in the real world. Okay, a sole proprietorship, just like it sounds like, is a business owned by one person. There are advantages and disadvantages to this. Now, there are many. We're just going to list a few here. Easiest to start. Technically speaking, in the United States, you do not need any paperwork with the government to have a business owned by yourself. As long as you do your taxes reporting as a business, you're fine. However, it is always recommended to do some kind of registration so you can have rights to the name of your business and nobody else can take that name from you, for example. Least regulated, very little regulation involved. You can pretty much operate as long as you're not breaking the law. Single owner keeps all of the profits. Well, goes without saying, you're not sharing your money with anybody. And taxed once as personal income. So let's say you have a regular job, a day-to-day, a day job, like they say, and you have, I guess in these days, they call it a side hustle, a business you run on your own. So the IRS and the state tax, the taxable entity, all they're going to do is they're going to add all that money together and count it as that's your income. We're going to tax you accordingly. There's no separation of your income from one side and another. Now, when you report it, you separate it to identify and itemize, but they're just going to count it all together and see what tax bracket you fall under, and they just tax you there. Now, disadvantages to this, limited to the life of the owner. When the owner passes away, you can pass down through inheritance like the assets of the business, but the business itself, it's pretty much ends. It will have to be restarted by the person that inherited the business, but then it becomes that. So I know it sounds like not a big deal, but it's just a legal issue, that thing that happens for other reasons. No need to cover them here. Equity capital limited to the owner's personal wealth. So there's only one investor, the owner, that one person that has the business. So there'll be some limitation to the capital, because the second you bring other people's money, now you have partners involved or investors and stockholders, and that's a different situation. Unlimited liability. There's no separation between your business and you and your personal assets. So because everything is counted together, if somebody was to sue you because of something with the business happened, let's say you own a restaurant, somebody got food poisoning or something like that, and they want to sue you, they can sue you for the restaurant, but depending on the damages, they can go after your house, your personal car, and all other personal things you have as well. So that's what I mean by unlimited liability. Everything is at stake, including your personal assets. Difficult to sell ownership interest. It's not that you can't sell your business. It's just that it's not like a corporation. You can sell stocks, or maybe a partnership. You can sell a percentage of your company to the partner already involved. It's a little more difficult to find a buyer, and especially the type of business will also be very dependent of the owner self. So it just becomes more difficult. So a partnership is very similar to the previous item we talked about. However, it's just two or more people involved. So the advantages and disadvantages are very, very similar. It's just that there's more people involved. So advantages, 2 or more owners. Now, depending how you look at it, it could be a disadvantage, but generally speaking, when you have more people involved making decisions, you have a better outcome. More capital available. So now it's not just your money, the one owner. Now you have 2 or more people that can bring capital, and you can start your business larger, which can grow faster. Relatively easy to start. While there was no paperwork involved in the sole proprietorship, well, it's not that there's no paper involved. There's no need for paperwork because it's just one person owning the company. Here, at least you got to have an agreement between the partners in some kind of formal contract where you sign it and everything. But everything else fairly easy to start. Income tax once as a personal income, the same thing we spoke about before. Everything gets your portion, your ownership of the business. You get so much profits. That's gets added up to another income you have, and then you get taxed once for whatever bracket you fall under. Okay, disadvantages: unlimited liability. Similar to what we said before. If somebody sues the company, they can go after the company and the assets of the individuals, the personal assets like house, car, etc. Partnership dissolves when one partner dies or wishes to sell. Similar to what we spoke before, once a partner leaves for any reason, the partnership is virtually dissolved. You can start a new one with everything pretty much the same, but it's a new entity. Difficult to transfer ownership, same situation. And maybe even more difficult than the previous example of a business, because as you see, if a partnership wishes to sell, it could dissolve the partnership. We're going to talk about corporations now, which this applies to S corporations and C corporations. C corporation is pretty much the same ones you always hear in the news, you know, your Walmart, Microsoft, Amazon. S corporations are specific type of corporations that have some other limitations that corporations don't have, regular C corporations don't have. But those distinctions are for a different course. When it comes to advantages and disadvantages, the S corporation and the C corporation are the same. Now, the first thing to talk about is that item here that says a legal person, quotation marks, distinct from owners and a resident of a state. So a corporation, once established, it's like if there's a person, it's considered its own entity. But the difference is that people can own pieces of that entity. Okay, advantages and disadvantages. Limited liability. Unlike the previous ones we spoke about, if somebody sues the company, they can only sue for the assets of the corporation. They cannot go after the house and car of the individuals that own shares in that corporation. Unlimited life. People can buy and sell their ownership piece and just keep on going. It doesn't die when somebody dies, when somebody sells. It only really dies when it goes bankrupt or when they just decide to shut down operations. Separation of ownership and management. This here there's a lot more details to the separation and complexity, but we're just going to go through the basic item so you have an understanding what they mean. So if you buy shares in a company, in a corporation, you are considered an owner. You have ownership. So you're a part owner there. However, you don't get to run the company just because you own shares. And it doesn't matter if you own a large percentage of shares, you're not the CEO. The CEO is the one running the company. The COO, the chief operating officer, the CFO, those executives and managers that work in the company, those are the ones doing management. The owners just happen to own shares. Now, does a CEO own shares in the company? Sure. But he's a manager because he's the CEO, not because he owns those shares. And that's what they mean by separation of ownership and management. Transfer ownership is easy. You can buy and sell stock all the time in the day-to-day easily. Easier to raise capital because of the nature of a corporation. It's easier to put your shares out there and sell shares, and that's how you raise capital. It's easier to go seek loans and debt by selling bonds or commercial loans when you structure as a corporation and you have a high level of equity. Disadvantages. Okay, separation of ownership and management is the same, it has an advantage as we mentioned before when we described it, but then it's also a disadvantage because if you are a shareholder, you have ownership, but you don't get to make decisions on how to run the company, the person making those decisions may operate differently from what the owners would like them to operate on. And we call that an agency problem. We'll discuss more on that later, but the point is, how do the shareholders get the CEO to behave the way they want him to when they don't really have any power over the CEO? Sure, a CEO can be voted out and all that, but it's a much more complex process. And that's what that means. It could be a disadvantage. Double taxation. Now I'm going to read the what's in parentheses, but I'll explain in a second. Income tax at the corporate rate, and then dividends tax at the personal rate, while dividends paid are not tax deductible. Let me tell you what that means. In the previous examples, we spoke about like partnership and the sole ownership. You just pulled all the income together, and then you counted all your income, and then you pay taxes at the personal tax level. Well, when we say double taxation of corporation, what happens is, because the corporation is a self-entity, once they do the income statement, taxes are paid on the profits of the corporation. So that money got taxed at one time there, at the profits of the corporation. However, those profits are not in the hands of the owners, the shareholders yet. That profit is still in retained earnings in the corporation. Now, if they don't move any of that money and give it to the shareholders, like in dividends, for example, then that's it. The taxation happened there once. However, if they pay a dividend, once the shareholders receive that dividend, they have to pay taxes on that money for their personal income side. So the same money, before it gets to the actual pockets of the shareholders, gets taxed by the corporate tax, and then it gets taxed for getting for the personal tax of the individuals that receive the dividends. And that's what I mean by double taxation. Before the shareholders can put money in their pocket, it got taxed at the corporate level, and then it gets taxed again on the personal, and whatever's left, then that's what they actually kept on the dividends. And that's what they mean by double taxation. Okay, that will be it for this video, and we'll continue on the next one.